Well, hello everyone. Hello. We're back live for a second time today. We were live earlier. I was live earlier, and I believe I was having some issues with my microphone again. It's like I'm going back and forward with that. So I'm gonna check before we start. I'm gonna check just to see if we have volume um, on online. Okay. Well, hello everyone. Hello. We're back live for a second time today. Yes, I can see that we have volume online, so we're gonna continue. Unfortunately, I didn't check on the last one this morning, and after I checked the recording, I find out that there wasn't I didn't have any sound. So for some reason, I don't know, my microphone wasn't connected the correct way or something like that. I'm not sure. The thing is that it was completely silent. So we're gonna do it again. So I just want to say hello, everyone. I'm Christian Arce, and this is another episode of Real Estate Talk, where I talk to fellow Facebook friends in the real estate industry and the lending industry, um, just to give you a different perspective of what's going on out there in the trenches right now, and share some good tips, ideas, and opinions from real people out there and in our industry. I usually talk to lenders, brokers, and real estate investors in general, right? Wholesalers, fix and flippers, that just people, investors out there doing it every day, grinding and just pushing through these, COVID-19 crisis, if we want to call it this way. I mean, there is crisis in some areas and not others. So we're going to talk a little bit about that, and and encourage you to take some action today. Okay, so really grateful today to be here and be able to share these with everyone watching. So please like and share. I would really appreciate that. Facebook, YouTube, Instagram, so we can reach out more people that is looking out for this information. Okay, so thank you again. Thank you in advance if you share. Now, I'm excited to talk today to you about funding. So today I don't have anyone that I will be talking with. I'm talking specifically more about funding and how to raise funding for your business. Specifically, more we're going to be talking about real estate, but some of these things, some of these strategies, some of these resources can be used for any type of business, really. And we're going to touch a little bit about that just to see how I'm implementing some of the same strategies that we have in real estate that I apply in real estate, and I applied it in some other businesses too. And it works, right? So because it's really the type of financing sometimes that we all look for to get our business up and running. So I was in the lending industry before I started investing, so long for a long time. And although I stopped practicing when I started investing about 10 years ago, um, I stayed in touch with the lending industry, and mainly why? Because it was we all need money to to run our businesses, right? And mainly for our real estate business, right? So, and now we are living in a moment that of a lot of uncertainty, right? And a lot of people are looking for money, not only for real estate, but for their regular businesses. Obviously, we know all the businesses around us are suffering a lot. So they're all looking for different ways to stay afloat. And real estate investors are not different, right? So real estate investors also took a big hit, and anybody that says that they don't they're not being truthful, because honestly, whether was a lot or very little, but we all got affected by this, right? Because obviously there is a lot of people out there without jobs, and the businesses, right? The same people that have businesses out there, they're also our tenants, our or property owners, right? They're also property investors. So they also have properties that they have to keep. So we all being affected somehow. So, but you know, sharing some of this information with you is just to encourage people to take some action on their business. So my goal today is just to reach those real estate investors and business owners that may need some direction, some ideas, or how to get through this, and how to get the proper funding for their deals and or business venture, right? So and using this platform, of course, to help out. So today we're going to focus on first in real estate, and then we're going to talk about how we can apply some of these principles to other businesses. Okay, so we're going to talk about the three main type of lending that I used, at least on my fix and flip business. And one was is hard money, right? We all know about it. Second is private money, private lending, and third is unsecured lending, right, or business funding. So, and it's not on that same order per se that I used it. So I'm gonna touch about that. I'm gonna talk to you about the first deals that I did and how I put those together. And that's the idea. It's just to kind of give you some different perspective and how I put it together without having any money at that time. So I started my business after the 2008 crash. So obviously we were going through credit crunch, and it was the same thing. It was going on some of the same things that we see today, but I think it was a little bit harder. The situation at that time, because banks, they completely stopped lending, and there wasn't hard money lenders out there. There was very limited credit available out there. So we had to kind of be very creative and kind of get, try to look for different ways to get financing for our deals. So how do we work with this type of financing, and how we can achieve our goals, and how we can, and also we're going to talk how I can help you in the process. Okay, so I'm also a real estate investor, but I'm also a business consultant that I'm helping a lot of real estate investors out there get started with their business. How I help them structure their companies and their deals to get started with their first couple of deals, and then put them in a path for success. Right, once they know the system, this is something that is not rocket science. It's just about implementing a system. Once you implement a system, once you create one deal, once you go over the hump of the first couple of deals, the rest of it is history, right? So you're gonna be able to go on your own, and then we can help you, of course, on growing little by little. But we gotta go step by step. So I will definitely I'm gonna touch on that and show you how we can help you on that. So let's get right to it. So who is this going to help? This is going to help, I think, definitely everyone that is starting in real estate investing, and is looking to see how they can structure their deals and how they can understand financing better. Okay, so the financing for real estate investing is completely different than the regular type of financing that we see out there. So so we got to touch a little bit about that, because I talk to real estate investors every day, and people that are starting right now, and of course, a lot of them, they don't understand what the funding, and they're looking for regular loans, right? So they're yesterday I was talking with a new real estate investor that here in Illinois was looking he's already under contract, and he was looking for a loan, and he was looking for a regular loan, like a regular conventional loan. And this doesn't really work for that type of, he's doing a fix and flip, so it's obviously there's better options out there where they don't have to go through all the craziness of going through a conventional loan to do an investment property, right? So So that's the idea. So, and also for the seasoned investors, right? The seasoned investors, those who have a few deals or more under their belt and already looking to grow, right? So if you're looking to grow, it's the same thing. I would like to help you and show you kind of some of my experience before. Of course, my experience hasn't been perfect. I have my ups and downs, but of course, throughout the last 10 years, I've learned a great deal on how to manage my business, how to manage cash flow, and how you gotta structure your business the right way to make sure that you're in it for the long term, right? That you're just not in the business for a few years and not being able to grow, right? So first, we're going to talk about harmony. So harmony, what is harmony? What is private money, and what and how and business lines of credit, how they can help you get started, right? So harmony is typically a loan that is a more specific type of asset-based financing, right? Through which a borrower receives funds secured by the real estate, right? A lot of the regular loans out there, right? The regular mortgages for regular buyers when you're buying your own house is also secured by your real estate, but it also looks it depends on your qualifications, right? Your income, your credit, and a lot of other things, right? That you have to be able to qualify for to get that loan. In Harmony, it's a little bit different because it's not about you in this, it's more about the property, right? It's a more asset based loan in which they look at the deal. If the deal makes sense, if the numbers make sense, meaning that that you can make money and the bank is going to make money, then it's definitely a good deal for them, and they will fund it, right? And they don't care as much as how good is your credit, if you have any income or not. Usually, hard money, as well as some of the private monies out there, they're looking right now for liquidity. How much liquidity you or your company has. Experience. What's the experience that you level that you have right now, whether you're right new or not, or many properties done, and then where the property is located. Those are kind of three of the main things that they're looking at now. Um, and based on those three things, they have different levels of investors, like they say. And then depending on those levels is how much they can lend you in regards of LTV, and then interest rate wise, right? So that's how they determine that. But it's definitely not based on your credit. Of course, your credit, they're going to want to look at that. Of course, it has to be decent. It doesn't have to be excellent, doesn't have to be 700 or anything like that, but you know at the same time doesn't have to be trash. Right? So keep that in mind. Private money is it's almost the same thing, but there's two types of private money, because a lot of people get confused with this. There's the private money that is done by private people, right? Private people where that and your brother, your mom, your dad, or anybody in your family or any friends that lend you money. Or is also, they call it private money to private companies, right? There are which you can consider hard money as private money as well. Okay, there's a lot of hard money lenders out there that they call themselves private lenders. And it's true, and it's simply because they're not an institution, they're not a bank. All right, so they're not a large bank. It's a company, it's a private company that raise money through different sources, and they lend that money privately, right? So it's not a bank, right? So private money, has two different ways. So is the one that is a company that lends you money, sort of like a hard money. Some of them are easier to lend, and then your friends and family, right? So but that's a different level. Just going to friends and family, I think that you have to go through the other type of financings first, and even be able to get some deals under your belt and get some experience before you go into your family and friends, okay, or even other people in your network, okay. Because it's going to come. The more deals you do, you're going to see that people are going to approach you, and there's a lot of people are actually going to start offering you money to do some deals. Okay, so and then business lines of credit. Business lines of credit is a type of small business credit that provides the flexibility that a regular business loan doesn't. Okay, so with business lines of credit, you can borrow up to a certain limit, right? So it's an amount that you were approved for, and you pay interest only on the portion that you borrow, right? That you spend. So, and how I this business lines of credit, a lot of people don't like it, and but a lot of people have been able to utilize that as a strategy to start doing fix and flips or any other type of real estate investing strategy. Okay, there's many of them. So, and I was one of them. Okay, so when I started back in 2010, after the crash of 2008, there wasn't many harmony, almost non-existent. Okay, there was only one or two that I knew about, and the other banks, the other mortgage companies, they wouldn't lend on properties that they're not in a condition to live, right? Unless you can get an FHA with a construction loan, but that is only if you're going to live in the property, not for investment, right? So, and conventional too. Conventional, you can do that too, but it's only if you're going to live in the property. So for investment, so we couldn't find at that time any type of financing, and the few hard money lenders that were on the market, they didn't want to lend to you unless you had experience. They wanted a lot of experience at that time, and we didn't have it. So we had to figure out whether we do it with our own money, which at the moment we didn't have. So we had to start looking for different things. One of my partner that today is my partner, still is my partner. The guy that I first started with had a great credit history, and together we were able to start applying for business credit, right? And that was the first thing that I didn't know anything about business credit at the moment, but for us it was like whatever, anything that we can get, let's get it, and let's get the first deal done, and then we start moving on from there. And it actually worked out that way. So the first deal that we bought, it was a 2-unit building in the Cicero area, and it was actually an ex-client of mine that was losing their property. He reached out to me. He says, "Hey, I'm losing the property. What should I do?" And that's when I got the bug, and I said, "Well, I should probably take this as my first deal." So I helped him out. We did the short sale on the property. It was actually a foreclosure. We did the short sale on the property, and believe it or not, this was to 2011, 2010, 2011. We were at the bottom of the pricing on the market, right? So we bought this 2-unit building where the owner was owed about $325,000 was his loan on that building. Okay, $325,000, and we were able to get that deal. We short sell it for $25,000, and $25,000 was the only cash that we had. Okay, um, and at that time we were applying for business credit, and we were able to raise between I think it was 60,000 or 70,000 that we were able to get in business lines of credit. Okay, so they came out right on time because the short sale took a long time to process. And once we were able to get it done, we had already the business lines of credit. So we paid for the building, 25 grand, and then we needed another $35,000 just to fix it. Right, we did all the exterior. The interior wasn't a big rehab. It was more cosmetic. some of the bathrooms painting and a good, really good cleanup on the property. So we spent about 35,000. Most of the money was spent outside on the roof and all new siding, right? And some windows. So, and we were in the bottom of the market at that time, and we put that property once as soon as we finished, we put that property back on the market. A week later, we got a contract on it for 125,000. Great deal. We only spend about $60,000 or so. So we practically double our money in the first deal, and that allows us to go to the second one and the third one and the fourth one, right? So what I'm trying to get to is that a lot of people are they don't understand how to use or how to leverage business lines of credit, even though the pricing right now is not the same. But there are areas where you can still buy properties this cheap, and there's still states. I know, real estate investors in Ohio, they're buying properties, buildings for less than 50 grand, right? So these are totally doable with business lines of credit. And that can give you the leverage to do the first couple ones. And once you do the first couple ones, then you move on to the next. A lot of people wants to jump right away into private money, and they say, well, I heard that we can use OPM, others people money. But I don't think it's the right moment to do it right from the beginning. I think that you have to gain some experience before you jump into private money. You have to be able to get some experience on the financing aspect of it, understand the financing, so that way when you structure deals with private people, you're able to structure it the right way, and you're able to keep those people as safe as possible. Because real estate is, of course, we all know is very risky, and we can make a lot of money or we can lose a lot of money. So the best way, I think, is to just gain as much experience as possible before you go into borrowing people's money, other people's money, right? Because obviously those are usually hard-earned money. There are savings and life savings for some of those people. So, the best way to succeed is to reach that level. But to reach that level, I think you have to gain a certain level of experience first before you're able to, and obviously to prove yourself that you're able to get these deals done from beginning to end, right? So for us at that time was the business lines of credit, the tool that kind of launches um, into the real estate market, right? And then from there, we were able to do, I think, about 3 or 4 deals that we were able to do with business lines, plus some of the cash that we did on the previous deals, right? So we kept some of the money for us. Obviously, we're doing this to make money, so we pay some money to us, and then the rest of it we kept investing in our company and looking to get more and more. I think after the fourth or fifth deal, that's when we were able to show that experience to hard money lenders, and we were able to get a line of credit, a hard money line of credit at that time. And it wasn't much. I think the first credit that they gave us was around $250,000, mainly because we already had money in the bank, right? And that's one of the things that I want you to take into account. We started with the business lines, right? And we kept doing a couple of deals with the business lines. But in the meantime, all the cash, we tried to accumulate as much cash as possible on our company to be able to show more liquidity. At that time, it's the same thing as going on right now. Right now, if the more liquidity that you have, the more money you can borrow, right? Whether it's hard money, private money, or any type of money, right? Or unsecure, even unsecure money. So there are business lines of credit out there that you can borrow against your own money, right? So, but to get to that level, you have to have that money available and not need it like right away, right? Because sometimes that money has to be there stuck to be able in a bank to be able to borrow against it. Okay. So, but to get to that level, that's one of the things that we understood from the beginning, that we needed to leverage and leverage and leverage to be able to do more and more and more. And when we were able to do, after the fourth deal or so, we were able to do, able to have enough cash reserves in our bank, and be able to show the bank that we had experience doing these deals. Then for that reason, these lenders say, okay, we're going to start with 250. And at that time we were doing deals, $50,000 deals. So for us, 250,000 at that moment, it was a lot. So we were really happy. We were able to do two or three more deals with that money, and then and kept our cash reserves, right? At the same time, doing that, so we started doing two more, and then with some of the business lines that we had another two more running, and our business started growing and growing, right? And then after we did, after a couple of years, we started, a couple real estate investors on that network started reaching out to us and started saying, hey, I would like to join and, maybe do some deals together. I have some private money that we can invest. But at that point, we felt a lot more comfortable with what we were doing, and we had our system running at that time, right? So we had our moment going, right? We had cash on our bank, and we didn't really need any more private money at that time. But they wanted to join us, and then we started doing more. So obviously, that investor came in, they gave us money to do two more, and then another person came in and we did two more, and the snowball just kept rolling, right? By 2015, 2016, we were looking at anywhere from 24 to 26 deals that we were running at the same time. Okay, at the same time, when we started in 2010, 2011 with one deal with business cards. By then, in 2016, I believe it was, where we reached that number. We were doing 24 properties all over the city at the same time. It was very crazy. Don't get me wrong. It was a lot of work. Um, there was a lot of money coming in and out very fast. A lot of people, a lot of contractors working with us at that time. A lot of stuff to manage. So, but what I'm trying to get to is that, by leveraging those deals and by leveraging one and two and three and four, we were able to get to more and to more and to bigger lines and bigger lines and bigger lines that allows us to do more deals. Now, not all the deals are pinky and nice, and of course, I would say 80% of the deals, they don't go the way that you want it to go. Okay, so they all have problems. They all have emergencies. They all have different things that we have to deal through, right? In some deals, we even lose money at that time, and so we had to kind of press the brakes and say, well, what are we doing wrong? We're doing too much or more than what we can chew right now, and so that's when we kind of started restructuring our company and say, well, why don't we do less, but bigger homes, or bigger transactions, or bigger constructions, and instead of doing so many little ones, right? So we felt comfortable with the little deals. So that's why we kept doing so many. But it can get to a point that was too crazy. We were all over the city, and we couldn't. The management was getting more and more difficult, right? So so for that same reason is that we started restructuring, and we started seeing how we can. Start doing less deals for more money, right? So we started going into more higher end areas. So we started getting into Oak Park and some of the north side properties, right? But hey, I went a little bit overboard with that explanation of the hard money, private money, and business line. But I wanted to kind of give you a perspective in there. I'm not trying to show off or anything like that, because in by any means, what I'm trying to get is I'm trying to press upon you the idea of you getting something started with very, very little, right? Like business lines of credit. A lot of people, I talk to investors all day long, okay, because I help them raise funds for their deals. And a lot of them are new investors, okay? And look, when I was starting, I was the same way. We were looking, the first time someone asked me, hey, how much money are you looking for? I was like, oh, I want 500,000, but we didn't need 500,000 at that time, to be honest with you. So we were doing small deals. Yeah, of course we wanted to jump to bigger ones, but we didn't need that much, right? So we were looking on the first ones, I mean. So a lot of new real estate investors are like, oh, we want to, 500 grand or 200 grand or 300 grand to start with, because they want to start with very comfortable. They don't want to have any problems of missing any money or anything like that. But the thing is that it's going to happen where you're going to be short of money on some of these things. And that's one of the things that I wanted to share with you. I wanted to kind of give you an example of what we do today, what we can see today. And I'm going to share my screen so that way you can see what is it that we how can you structure some of these deals, and how you can put something together. Just going to give you the example that I talked about earlier, my first deal, and how I put it together so that way, and then how we jump into harmony, right? And how we were able to combine some of those things. Mainly, I talk about that. I talk about the past, and I talk about that time mainly because is the time where we needed money the most. At that time, the hard money lenders, they were not lending 90% like they were lending right before COVID. A lot of the real estate investors were getting used to getting 90% of everything that they needed, and even 100% of the construction cost. And now they went back to the beginning. Now some of these lenders are asking you for 20, 30, and even 40% down. Okay, so that's what I wanted to show you. How um, I'm going to switch my screen, so I'm not going to see myself here, but I'm going to show you how we were able to kind of structure some of those deals. Okay, so the first thing is we're going to go through an example of $100,000 deal. Okay, so we need $100,000. Usually one of the things that you got to have in mind for you to be able to get that much money, you need to make sure that your ARV on your deal is correctly. So for a deal like this of $100,000, your ARV at least have to look anywhere from 150 or more. Okay, so but now, recently, just recently, right before COVID, let's say in January, for this deal, you only needed 10%. Okay, you only needed $10,000, and you can get that. Okay, and get the rest of it all financed, right? But now for this same deal, you're gonna need anywhere from 20 to 40 grand, okay, to get that deal done. And let me show you why. So let's take an example. Let's say that we find a deal that is $50,000, to buy, right? So it's a 50,000 property, and then we need to fix it for another 50,000. Okay, so we're going to use round numbers to make it easier and go a little bit faster. Okay, so we need a hundred grand total to get this deal done, right? So um, first of all, now most of the real estate investors, they understand, they know about hard money lenders. Most of them, okay. There's very little people out there that they don't know about hard money lenders. So if you look online, all the groups on Facebook and everything, real estate investors are looking for hard money all the time, right? So a hard money lender right now, they're going to say, okay, so if you need 100 grand, this is your loan to cost. Okay, so you need to buy, and construction you need 100 grand. So this is your loan to cost. From there, if you're a beginner, okay, if you're new on real estate investing, you're going to be looking at 75, okay, to 80% LTC. And that is something that you're going to be looking at now that you didn't see before. Okay. LTC is something that the hard money lenders came out with the last few years. They never used that before. Okay. So 75 to 80% of the LTC. What that means is that is the money that you need to buy the property, and the money that you need to rehab that property is your loan to cost. Okay. And so they're going to lend you 75 to 80% of that. And what is that? That is based mainly on, one is the experience that you have, the experience level. Two, the liquidity, right? And then three, um, what was it that we mentioned? Experience, liquidity, and I can't remember the third one. Um, and property location. Okay, property location. So that's very important. The more risky the area, the less money you're going to get as well. Okay, and that is something that obviously we all deal with because you know we tend to go to the cheaper properties, right? So the cheaper property, the cheaper the property, the worse the area. Sometimes, most of the times, is the case, right? So so obviously the more risky the area, the more risk for the bank, for the private lender. So, you're going to need more money, right? Sometimes they're going to ask you for more. I have a situation where I had an investor from California with zero experience was trying to buy a property here in Inglewood in the south side of Chicago. And the lender just kept asking for more money, more money, more money, and they got to a point that they were asking about 40% down, okay, on that deal. And I think it was about $100,000 deal, and the guy was he was looking like actually like more like 50 or 60% that he needed to put, but the area was too risky. Okay. And even more when it was right on the beginning of COVID and stuff. So, and his level of experience wasn't there. So it was, and he was living at a different state. So even worse. So, so those are the things that you got to have in mind. Okay. Experience, liquidity, and location. Now, a lot of the people that are starting in real estate, they don't have the first two. Okay, sometimes you can have the liquidity, but you don't have the experience, and sometimes you have some experience, but you don't have the liquidity. So, and that's where we bring the business lines into the equation. Okay, the business lines are something that, of course, they're not easy to get either. Okay, they're not for everyone either. Business lines is something that like I mentioned before, it gives you a flexibility that no other loan gives you. Okay, why? Because you can use it on whatever you want. Okay, business lines, yeah, as long as you qualify for it and you're able to raise some money through it, then you're able to use it on whatever you need. So you can use it on your down payment or your construction. Okay, so you can use it for liquidity and to gain more experience. So business lines of credit is something that you're only going to be able to get it if you have 700 credit scores or more. And this is not only about the score, obviously you need 700, but 700 is not what it used to be before. This is something that I was talking to another real estate investor not long ago, and which he thought that he had great credit because he was, I think, 720 or so. But lenders now, they not lenders, but the credit bureaus, they have changed the way that they score people. So there's a lot more people out there with 700 credit scores, but 700 credit scores are no longer excellent. It's just okay. Okay. Yes, and you hear that right. It's just okay. It's not excellent anymore. It's good credit, but it's not excellent. They consider very good after 740. Okay, and excellent credit after 780. Okay, and we look at credits every day. Okay, credit reports, you're going to see different credit reports too. So I would suggest this company, if you want to look at your credit report and you want to look at your real different types of scores that you see out there. There's this company that is called myfico.com. I don't, I'm not affiliated with them. It's not my company or anything like that. It's just a company that you can check your credit, and also you can monitor your credit in there. um, but what they give you something that no other company, I haven't seen in any other credit report, which is the different type of scores that you have. A lot of people, they think that there is just one score on three bureaus and that's it. But no, there is scores for credit cards. There's scores for mortgages. There are scores for car loans. There are scores for personal loans and many other ones. Okay, and a combination of them. Okay, so there is a bunch of different scores. That's why, depending on where or what you're trying to borrow, is how your scores comes up, and that's how sometimes you see high interest on some things and low interest on others, right? So like mortgages right now, regular mortgages, right? Retail mortgages are very low, but you go to business lines of credit, or anything that has to do with business, and they're very high. Even though you have high credit scores, still, the interest rates on those are high. The same thing with hard money or private money. The interest rates are still going to be high. Okay, until you get more experience. Okay, now with business lines, like I was saying, you need about 700 credit scores, and then you need a credit history of about, I would say, at least 10 years. You can do it with less. Okay, I've seen people that have 5 years, right? But then in those 5 years, they've been able to create a great credit history. All right, so it's all depending on what you've been able to build on your credit on the last 5 to 10 years. um, Unfortunately, or of course, there is a bad rap about credit cards, right? Personal credit cards. A lot of people, they say, well, don't get into debt, don't get credit cards, just try to keep it at a minimum, so you don't get behind. And that's fine too. But the thing is that when you are getting into business, I learned that in order for you to get funding for a new business, when you're a business that, or you're already been out there for years, many years, and you can prove cash flow on your business, you can get money fast, right? But when you're starting a new business, let's say that you want to go out and start fixing flipping properties right now. uh, Sorry about that. And you're just starting up, so you're not going to be able to find financing for your business very easily. So the way that is done, the way that we can get it done, is based on your credit history. The better your credit history, the more funding we can get for your business, right? And when we talk about here is, we're talking about years, and then credit credit history, whether is credit cards, and personal loans, right, and mortgage, um, and car loans, right? So the history on that. But when you go to business lines, the main ones is the business credit cards. Okay, so they're going to be looking at your personal credit cards. Okay, they're going to be looking at how much the relationship that you're being able to build with these banks, and how much you're being able to get those lines, your personal lines, right? So if you have, personal credit cards for $2,000, then you're going to get very little for your business. But if you have personal credit cards for 10, 15, $20,000, then they're going to match that and sometimes even double that on your business. Okay. So, and again, so a lot of people are afraid of getting into credit cards and getting into debt. But again, the credit cards, you're only going to get in debt if you use them. Okay. So you have to be very mindful of that. So the idea is if you're looking to start a business, whether it's maybe next year or whatever the business is, it doesn't have to be real estate, whatever that business is, I would suggest start creating more credit history under your personal name. Okay, so you got to start getting those personal credit cards on high limits. Okay, high limits. You gotta start, asking for credit increase. It doesn't mean that you have to use it more. Okay, no, just keep it. When I talk to a lot of people, I tell them, look, if you get a personal credit card that is $10,000 in credit limit, okay, you got to put in your mind that instead of $10,000 credit card, you got a $2,000 credit card. Okay, why? Because you're not allowed to spend more than 2 grand. Okay, so you gotta keep it under 20% or 30% at the most. Okay, and you use it if you need it, but at the same time, if you don't need it, it's better not to use them. The idea is to build up your credit and your credit history, not to spend that money, right? So those are two different things, right? When you see people out there that are looking to they're afraid of getting credit cards is because they think that they're going to start paying, they got to pay for all that stuff. You're only going to pay for that stuff if you use it. Okay, so that's the idea that you got to have. So as long as you have that, then you will be okay. Okay, if you need to spend some money, try to keep it under 20%, and that's going to increase your credit and your credit history on any level, whether it's a loan, credit cards, and then you need, more than one. Okay, so you obviously got to look to have three, four, as many as you can, honestly. So, and that's going to give you the leverage when you open a business to have that. Once you have it, I think at least for a year, you can start looking into business credit if that is something that you need. It doesn't mean that you have to. Okay, sometimes if your credit is good already, you don't have to do any of that. But this is for those that they're still building their credit. Okay, now how do I leverage this business line to do that first deal? So when we look, first of all, we talk about that we got a 325,000 dollar property, right? I had a loan for that, and we got it for 25,000, right? So that was one of the things. So it's a very low price property, but even if it is we also got another property later on for 45, right? So you can do fairly low amounts with that. Okay, so but the first deal was 25, so we were able to pay for that, and then we were also able to pay for the um, renovation, right? And again, these business lines, they come for a 0% interest on the first year. Okay. So we were doing this whole transaction. We did it all in 3 months. Okay. At a 0% interest. Okay, for the first year. So the first year is the best year to take action, right? And to be able to get that first deal done. And even if he's not all into that, any money that you use with business loans are going to be at a 0% interest. And then from that, after that, I believe after a year, sometimes lately because of the COVID-19, we've seen some lines even go up to 2 years for 0%. Okay, and then after that, it's going to go to a regular, credit card interest rate. Okay, which again, we only pay for the amount of money that we use. Now, the other leverage, the other thing that I like about business lines is that um, when we use it with my partner had at that time 800 credit scores. Okay, so one of the things that I wanted to is I didn't want it to affect this, right? So because as you grow in your company, there's two things that you're gonna need. And one is the credit score, and the second one is the liquidity that we talked about, right? So liquidity, 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 right? But your credit is going to give you the access to more and more capital. Okay, so in order to keep this intact is you have to try to stay away from personal loans, or loans, or regular mortgages. Like for example, right now I have an investor working with in Texas that he has 5 mortgages in his credit, and he's like, he makes great amount of money, he has a regular job, he makes great money, so he qualifies for all 5 mortgages, but he can apply for anything else now, right? Because he's like over leveraged. So now we're working to get all those loans into a private loan, right? Hard money. That is not a hard money, but a private loan that is going to be for rental, because these are for rental property. It's going to be a long term too. It's going to be a little bit more expensive than a regular mortgage, but it's going to take it off his credit. Okay, so and he's going to be able to leverage his credit even more after we do that. Okay, but at the same time, but he still has the credit. Okay, just simply because he has good history. So getting those two things, the business lines of credit, they do not report to personal credit. Okay, so what it means is that it's not going to affect your scores, and it's not going to affect your personal DTI. Okay, that's very important. Okay, this is very a lot of financing stuff. Okay, but this is what you need to understand in order to get some of these deals done well, so that way you don't get surprises later. Okay, so the DTI is the debt to ratio, is a ratio, debt to income. I'm sorry, it's a debt to income ratio that the lenders use. Okay, these are used more for regular financing. Okay, for your regular mortgage company out there, and then obviously some of the credit cards, some of the car loans, some of the personal loans, they utilize this ratio, this DTI calculation, to see how much you qualify for, and the higher your ratio is, um, the less you can qualify for things, right? Let's say for mortgages, the high ratio you can go is, I've seen going up to 51, 52%. Okay. And this is from your income. Okay. Now, usually they don't like, honestly, they don't like to go over 45%. Okay. So let me go down a little bit. So usually they don't like to go over, uh, uh, over 45%. But but sometimes they depending on the history, they allow some borrowers to go to 50, 51, 52. Now, with hard money, with hard money, we don't use this. Okay. With private money, we don't use that. Okay, so we don't use this. And then with business lines, um, this is not going to be affected. Okay, so that's why you want to try to keep all on your business, right? So hard money is under your business only. You can do it under your name too, but it's not, it's not convenient. Okay, so hard money goes under the company, private money always under the company, and business lines, of course, is going under the company. So getting those are kind of the perks for that. Having a business lines is first, not reporting to your credit. Second, not ruining your personal DTI. Third, no lowering your credit scores. And then fourth, the ability to use it in full without affecting this. Okay, so that is how you can leverage that and be able to start doing some of these deals. Now, I know that this kind of got a little bit complicated, so feel free to send me any of your questions, and any of the things that you, if you didn't understand anything. I know that I have some really uh, experienced investors on the line. So I really appreciate you guys being here, and I really appreciate the support on watching this. Okay, so thank you for watching, Jason, Eugene, Matthew, Mercedes, and Joe. I really appreciate you guys, and love the support. Okay, so but again. I got a lot more information about, financing and all this stuff and how we can structure the deals. But, sometimes it can get a little boring, to be honest with you. I like it. I've been on it for a long time, so I know, like the back of my hands, and I know how to put these things together all the time. So I would love to work with you. I would love to, help you, improve in any way that you can. Feel free to give me a call, and let's set up a time to see how we can, how I can help you, and share my experience with you, in any way that I can, so that way you guys can grow more. So I'm open to do any of that. So feel free to reach out. Okay. So now, let me see what I have, what else I have to that we're gonna go for. We were talking about also that how we can use some of these things on different businesses other than real estate. And I had a bar business before. I had a mortgage company before, a real estate company, and they all need money to sustain. And even though, yes, when you work with these companies, you can generate money, the profits that you generate with the company. There are things that you need to pay for sometimes when the money is not there, or when, like, just to give you an example, a bar that I used to had a few years ago. One of my partners in real estate was, had the experience on that, so we jump in an opportunity to open a bar, and I took it as a real estate deal, because we were able to get the property under owner financing, and then we renovate the property. We were able to take a loan on the property to be able to renovate that, and then we started running the business, right? And then it worked out for a good time, and then we decided to jump out of it. When we sold it for a good profit as well. So plus, it was a buy owner deal, so a owner finance deal, so it was great. And it was from someone that we know. The original owner was someone that we know for a long time, and worked with us on real estate for a long time. Still work with us today. So it was a great story. But either way, so we needed money, and the business lines came out very, very handy when you're starting that new business. We needed furniture, TVs, a bunch of things, that we needed to get, food, beverage, cups, and I mean, the amount of things that we needed was incredible. And of course, my partner at that time, he knew more about that industry than what I knew. But I did all the real estate. He did all the bar business, and it was a great experience. But we needed that extra financing, and I was able to get the property on owner financing because of why? Because of the knowledge that we know on how we can structure a deal, how we can structure a loan, or a owner financing transaction with the owner, right? And at the same time be able to get financing for everything that we needed to renovate the place, and at the same time to get the business up and running. So like I said, we use the same things. I use the same tools that I use on my fix and flips. I use it to help a lot of other business owners, and I have right now working with a Mexican company, a group of five brothers that have restaurants all over the city, small taco places but they buy their own real estate. Okay, these guys are very smart, and every time they open a new business, they buy the real estate, they fix it, and they put up their own restaurant in there. Which is very complicated because sometimes when you go out and you try to get financing for a business like that, where you are going to be the cash flow, right? Your business is something different when you say, well, I'm buying a house, I'm going to fix it, and I'm going to rent it out, and I'm going to make money with that, right? Usually banks are more comfortable with that when you have a tenant, right? But when you're saying, no, I'm putting my own business, banks are like, okay, this is a little bit more risky for us. And sometimes they're a little bit more sketchy to lend you the money. So with business credit, he was able to get a great deal done, and wasn't in need to borrow as much money as he needed. And the good thing is that you can grow those lines over time, right? So you can start like we did on the first deal. We started with 50, 60,000, somewhere around there. And then after 10 years or so, 5 to 10 years, we were able to grow those lines to like $300,000, which again is not a lot in the real estate world, right? But it's great amount of money to do small deals and to pay for operation stuff and different things on your business, whether it's real estate or not. Okay, so the idea is that to be able to control that and be able to leverage it on your for your convenience, right? So you can use the same. Some of the same lenders are getting into more commercial as well, commercial properties and things like that, mixed use and everything like that. So for wholesaling, the same thing. This type of financing, wholesalers, they also need to start with this. When you start in real estate and you start wholesaling properties, one of the first things that you need, I would say, is business funding. And you can start with that. You can start creating that business funding little by little there until you start growing into fix and flips and rentals and short-term rentals too. So we also partner with a couple of private money lenders out there, a couple of local ones here in Chicago, that we can provide also hard money and private money from some of these companies. So definitely, if you're looking for any financing like that, reach out to us, and I will be able to help with that as well. There is a lot of different options out there, but the more generic stuff that you're going to be looking at is going to be the liquidity that they're looking for: liquidity, experience, and location. Okay, so we got to talk about those three things to be able to see how we can structure your deals and be able to help you to get more out of it. Okay, and be able, whether are rentals, short-term rentals, fix and flips, or any of that stuff, or even wholesale deals. If you need transactional money or anything like that. Okay, so a couple of other things. Fine, before we leave. I wanted to talk about was what has changed in the last few months, and one of the things that we say was that, right, is the amount of money that you're able to borrow now against the property. Even doing against properties, the amount that you can borrow is a lot less. Okay, so that's why we're utilizing now more term loans for cash and liquidity, or business lines of credit to be able to grow. Okay, so that's it for me today, guys. I really appreciate you watching. I hope I gave you some good insight on financing, and I hope I you learned something today. I hope I can help you. I'm available for you if you have any questions. Please feel free to reach out, and I'm gonna put my information here in case you wanna talk to me. You can best reach me through my social media, which is through Facebook or LinkedIn. Those are the two places where I spend the most time. So feel free to reach out through that, or if you have my phone number or my email address, definitely be able to reach out through that, or my um, you know. My website at christianarce.com. Definitely be able to get in touch with me, and let's get your deals going. Let me help you grow your company, or even get started with a couple of few deals. There's a couple other options that we can talk about, that some of the things that we utilized in the beginning as well, that I didn't get a chance to talk about that today. But definitely there is a lot of options out there that we can help you with. Okay. So again, thank you very much. I appreciate everyone watching, and I see you next week. Thank you.